So what we've been talking about, I do have some folks online, but what we've been talking about is the cost of doing business. And one of the things that we looked at is making sure that we understood how important those costs are and the related cost curves. And one of the things that we identified with our cost curves is our total fixed costs and our average fixed cost are something that stays the same no matter what we're doing, no matter how many units we're producing. Now, the average and the marginal costs are the ones that are going to be the most important to us. So while we have price over here on the vertical axis, our average fixed costs have a curve that is downward sloping. Now, it's downward sloping regardless of how many units we provide. Now, that's going to get closer and closer to the bottom axis, but it will never touch. And the reason is because with every new unit, we're dividing that by the cost. And so as the number of units increase and the cost stays the same, that curve is going to be descending, coming down to it. The other curve, the other two curves that we're going to be looking at is our average variable cost, and that's going to have a U shape. And some of the questions that I put into the quiz is, why are they U-shaped? And the simple answer is because of the law of diminishing returns. Our average total cost is the summation of these two. So we have our total fixed cost, our average fixed variable cost, and our total fixed costs are going to have a curve. There's a combination of a continually descending of a U-shape and then the combination to those. So it'll have a little bit steeper curve itself. And then the final one that we have is our marginal costs. And of course, our marginal cost is going to be what happens if we produce one more unit? What happens to our overall cost? What is the new cost of producing that one more unit? And that's going to be important because it's going to cut through the lowest point on all of these cost curves. Now, this model applies to this next thing that we're going to be talking about. It applies to all of these different market structures that we're going to be dealing with. So in looking at this, I've put up a market structure where on the one side, on the left-hand side, we are very competitive. And on the right-hand side, there's no competition. Cost curves start filling in 4 different market structures. Perfect competition is going to be the most competitive. And I'll tell you in just a minute that it's more competitive because we have many, many, many producers and sellers. A little less competitive is the monopolistic competitive market, the oligopolies, the duopolies. And oligopoly and duopoly means there are few, and then duo meaning 2 means that there's probably 2 major players. And then finally, the no competition side is the monopoly. So in the book, they talk about 4 different models. I've added the duopoly because that really is one of those things that we see in the market today. The cost curves that we put up there are applicable to all of these models, but a little bit different format. You'll have the total fixed cost, you'll have the average fixed cost, the average variable cost, you'll have the marginal cost. And each one of those things are going to help decision makers identify the optimal level of output. And that optimal level of output is related to the maximum profit that can be made. So again, here's the cost curves that I introduced. And you'll see that the costs themselves follow that same logic that I went through earlier, where at the very beginning, we're going to have cost fall. And the reason they call it fall, again, let me just repeat this to sink it in, is because of the law of diminishing returns. The law of diminishing returns says as we increase inputs would be labor and raw materials and machinery, capital, and those kinds of things. As we increase the inputs and we have excess capacity, our overall average costs are going to be falling. At some point, however, when we reach the capacity in a short run of our capital, of our factories and what have you, that's going to level out. And then at some point, it's going to start to increase. And this is true of all of those costs that you're taking a look at right now. One of the other questions that I had in the quiz is, what is the relationship between marginal cost and average total cost? And the relationship is this: as marginal costs are decreasing, so are average total costs. Okay? As marginal costs increase, then that's going to pull up the average. And you remember last time we met, I gave an example of your grade point average. If you have one additional class and the grade point average is below your average, you see it's below that average, it's going to pull your average down. If it is above your grade point average, then that marginal change is going to increase your average. So when we look at the characteristics of these different kinds of industries, there's obviously the huge manufacturing, the utilities, the car manufacturing, the airplane manufacturers, they're going to be huge because the capital investment is just so large. We want to identify what is the optimal level of output. And those cost curves are going to give us that indication as to what those levels of outputs are. A consumer demand is going to be one of those things. We want to recognize our revenue maximization, how much money do we have coming in versus how much money we have going out. So the comparison on that spectrum I've listed here. Some of the things we want to identify is what are the characteristics of these four, even though I have five. Put the duopoly in with the oligopoly. What are the characteristics that distinguish one industry from another? Number of firms. With the perfectly competitive, which we're going to focus on today, we have a very large number of competitors. Monopolistically competitive, we have many. There's something that they've done to distinguish themselves, and entry and exit is not going to be as easy. The oligopoly are few, and there's only one monopoly, of course. The type of production, it's going to be fairly standardized. If I look at the standardization, look at apple farmers, for example. There are a lot of different apples, but they're all pretty well standard. It's not for most of us. We will exchange one apple for another apple if it's available and if the price is right. With the monopolistically competitive, they've done something to distinguish themselves. And I use apparel, for example, because with 5 daughters and going school shopping, I of course want the daughters to buy the cheapest jeans, and they want to do something that is distinguishing themselves. So they want to buy the most expensive jeans because that fits into their lifestyle at school. But there are brands who distinguish themselves, even though there might be some alternatives. And so we call that a monopolistically competitive. They have a monopoly on that brand. Automobiles are another one. Even though they might trend more in the oligopoly, you know that there are brands that people prefer over something else, even though they all have 4 wheels and they get you from one point to another. When you look at the oligopolies, it's one of those things where maybe you're looking at athletic shoes. There's a few that compete high end, and people are willing to pay quite a bit. In soda pop, for example, there's probably 2 main competitors there, even though there's a lot of knockoffs and what have you. You put those all likely into oligopoly along with airline industries and what have you. So you look at the pricing strategy. For the perfectly competitive, they are price takers. In other words, they don't have a lot of ability, if any ability at all, to set their own price. If you look at agricultural goods, for example, they are price takers depending on how much supply is put in. If you have the demand, if there's a lot of alternatives, they can't really set their price. They are price takers. If you have this distinguished brand for the monopolistically competitive, then you have a limited price ability, but there are alternatives. And we know that substitutes have the ability to change the demand curve for certain goods and services. The oligopoly is an interesting one, and we'll get into this in a week or two, where we talk about the mutual interdependence. In other words, I have to take a look at what my competitors are doing to set my own prices. I do have some ability, but if my competitor changes their price, then I likely have to change my price as well. And we look at oil, for example, and that's one of those things where you have gas stations who advertise. And if your competitor kitty corner from where you are changes their price, there's some pressure. You don't necessarily have to do it, but there's some pressure in changing the price or matching the price or following that lead. And then, of course, the monopoly is a price maker. They set their price wherever they want to, but they don't necessarily set it at the highest level. When we say they set their price at a level, if they did the highest level, they may not be making the most profit coming into it. We'll get into that in a couple of weeks as well. Finally, the condition of entry and exit. One of the big ones, as I mentioned, for perfectly competitive, it's very easy to enter and exit. Depends on what you're making, obviously, but if labor is available and it's not a complicated manufacturing process, then it's going to be easy to get in, easy to get out. And as you become more and more less competitive, then the capital investment and those kinds of things are going to be one of those things where you're not going to have a lot of people entering and exiting the market just because of the cost of getting into it. And in the monopoly, in many cases, entry and exit, well, exit would be okay, but entry into the industry is really blocked. And when we look at natural monopolies, which would be a lot of the utility companies that we see, people are blocked from coming in. And that goes back to, we don't want to have a lot of electrical lines running down the street with a lot of competitors. That would be cost prohibitive, really, when we look at
that. Is that why Rocky Mountain Power is really big? They're the only one.
Yeah. And so they have a natural monopoly, and it's a legal monopoly that is granted by government.
Yes.
So the government sets up a commission that looks at these natural monopolies, where we look at everything from water to electricity to natural gas and what have you. And if you think about it, running electrical lines or pipes underneath the street or whatever the case may be, we have 4 different companies in each of those, then that capital investment will be 4 times greater than what it is right now. If that's the case, then the cost to the consumer would be much greater as well.
Yeah.
And so that the Trade Commission, and they call them different things in different states, but they would set a limit and they regulate the price. So in some cases, you're a price maker, but if you have a natural monopoly, then you are limited. And it's kind of a weird process because they go in and say, here's my costs, and give me a little bit of a profit margin because I have investors. So with Rocky Mountain Power, for example, they set it so that the investors can make a profit, but they cover their costs. Now, the difficulty in something like that is there's no regulation on the costs in most cases. And so if they're going in, and I know that Rocky Mountain Power, I go to their center every year, they're building windmills up in Wyoming, in the plains out there. Well, that's costly, so they're covering that cost and still making a profit above and beyond that. But if they were not regulated, then it may be even higher. So there's some interesting things when we talk about monopolies and government intervention. And then finally, the promotion strategies. And here's something that I think is so interesting because it doesn't make a lot of sense for a perfectly competitive firm to do a lot of promotion or advertising and what have you. Think about corn, for example. You may have an association try to promote corn, but an individual farmer doesn't benefit from spending that money. Their price is set, they can't cover those costs, and so they're price takers, and it doesn't make any sense. For the 2 middle ones, monopolistically competitive and the oligopoly, that's where it makes sense to do the advertising, to try to draw people into their unique brand. And for the monopoly, the advertisement is purely public relations. Now, when you see the gas company and the electric company doing ads trying to get you to reduce the use of their product, it's kind of counterintuitive because one of the things that you see is advertising is to try and get more usage of your product. In this case, what you're looking at is use less of our product, be more conscious and what have you. But that's because they have other options. If they're sending the gas or redirecting that to other places like California, then they can get a higher price for that gas or electricity or whatever the case may be. But it's more public relations than it is profit driven as it is in the middle tube. So again, when we look at the perfectly competitive market, it's a theoretical concept. As I look at each of these markets, I'm not sure there is a pure perfectly competitive market itself. Even if you look at apples, which is one of the examples that I gave, you do see the distinguishing factors. I mean, they have little stickers on them now. If I were doing the shopping, I would not, one apple from another. My wife is going to look at, oh, this is a red delicious, and this is a, whatever it is. And those stickers, give some indication. But nonetheless, if I look at what is an example, agriculture is probably the best and closest I can come to it. So again, just to emphasize what we're going to be talking about today, large number of sellers, standardized product. When I say standardized product, I also mean that there are many, many substitutes for the product itself. And that's one of the reasons why the price is set, and these folks are price takers. Very easy to get in and out in most cases. And then the demand curve for a perfect competitive firm is pretty well set. It is the supply that really dictates, much of the price. So in this example right here, I want to show for the individual firm itself who's producing things from, whether it be skateboards or agricultural products, we know that the market supply and demand is going to have that equilibrium put into it. That's going to set the price in the market. So the market itself is going to say, here's the price and here's the quantity that is going to be sold in the industry itself. For the perfectly competitive firm, their demand curve is going to be perfectly horizontal. And that demand curve is going to be equal to the market price, and it is also going to be our marginal revenue curve. So when I say marginal revenue curve, what I'm saying is that for every new unit that is being produced, is going to add the same revenue for the firm. Okay, it's going to be one more revenue. So if I'm selling these things for $10, the next item that I sell is going to add $10. And I sell the third one, that's going to add another $10, and the fourth one, another $10. So as we look at the marginal revenue being equal to the demand being equal to the price, is going to be the characteristic of a perfectly competitive firm. Now, in the industries, the four industries that I talked about, one of the things that we want to make sure of is that there is a distinction. This is the only one where we're going to have that perfectly horizontal demand curve. And I know that we've kind of conditioned ourselves to say the demand curve has a negative slope, but in this case, what it really means is that the small competitor, because there's so many different competitors in this industry, they can sell as many units as they possibly can, and the price is not going to go down. They're price takers. The market is going to set that price. But they are such a small component of the overall market, the overall industry, you can maximize your output, and the price is not going to go down because you're producing more. Now contrast that for a minute with the monopoly. The monopoly is going to say, if I produce one more unit, because I am the market, I am that left-hand side module, if I sell one more unit, my price is going to go down. But again, the perfectly competitive firm can produce as many units as it possibly can, and the price is going to go down. The limit is this small competitor is going to max out their capitalization, their factory, their equipment, and everything else. And so they're not going to produce more than it's going to cost them to produce it. So in this case, if we're looking at the individual firm, we know where our price and demand is going to be equal to our marginal revenue. It's going to be equal to our average revenue as well coming into this. And our firm's revenue data is going to go up by the same amount no matter what. So in this case, we have $131 being our income coming in for every unit that we sell. And we know that our total revenue is going to go up, as I have indicated by this almost 45-degree line coming up. So again, our marginal revenue is going to be that $131 no matter how many units we sell. Each new unit is going to bring that $131 into the system. So a typical question on this would be something like this in our chalk talk. Which of the following is not a characteristic of a perfectly competitive market? And I'm going to give you a second to take a look at that. Okay, do you have your answer? It is C. It is difficult for a firm to enter or leave the market. It's really easy for a firm to enter or leave the market. Okay. Next one. The demand curve for the product of a perfectly competitive firm is, and I'll give you a moment to take a look at those. Come up with an answer. And the real answer is perfectly elastic. So the demand curve is horizontal, perfectly elastic if we were to put it in a little bit different way. So anytime that a firm wants to identify, how do I maximize my profit? Here's the three questions that must be asked and answered. Should the firm produce at any level of output? And when I'm asking that question, what I'm saying is, if I produce at any level, am I going to make any money coming in? You could produce at a certain level or any level, and if your costs are too high, then you're losing money. So obviously, if you're losing money, don't produce anything. But if the answer is yes, what is the optimal amount the firm should produce? And one of the things that a lot of people miss is, how do I maximize profit? Well, it is really related to your total output. You know, how many units you produce, because at some point in time, especially when we look at the marginal principle, we're going to be looking and saying, if I produce one more unit, am I going to bring more revenue into the company? If I produce one more unit, am I going to bring less into the firm? And then the third one is that at a given level of output, what economic profit or loss will be realized? So yes, as we said before, you may bring more revenue in, but is it producing a profit or a loss? So the rule here is a business is only profitable within a certain range of outputs. So you produce too little and you have too much capital that's being unused. You're still paying for that capital in your fixed cost, for example, but you're not covering those costs. So again, think of the law of diminishing returns. Think of your cost curve being U-shaped and costs coming down, bottoming out, and then starting to increase as well. It's that sweet spot that you want to get into in producing goods or services. So we either want to maximize profits or minimize losses. And when I say minimize losses, one of the things that we want to take a look at is there may be times where you continue to operate at a loss. With prices being flexible, for example, you don't want to necessarily just go out of business, but if you can weather a minimum loss for a period of time, you may want to still produce certain goods and services. And I'm going to talk about that when we get a little further into this. What it really has to do is, am I covering my variable costs? So just keep that in the back of your mind. So in this chart right here, I want to look at that same concept of going through and producing one unit to 10 different units. And am I covering my cost or am I not covering my cost? And obviously, if I produce 0 units and my fixed costs are $100, I need to bring in at least $100 to break even. And that's from a financial standpoint, not necessarily from an economic profit standpoint. But you can see as I produce more units, what's happening is I still, on the far right-hand side, for the first 3, operate at a financial loss. When I start to produce, when I start to produce 3 units, then I start making a little bit of a profit. And as you go down this list, you can see that there's a point where I maximize that profit, but then there's a point where it starts to drop off again when I produce the 10th unit. So that's my profit and loss coming in, even though my total revenue in the total revenue column continues to go up from 9 to 10, my total profit drops by $19 if I produce one more unit. That's the marginal principle. What happens when we produce that one more unit is I'm bringing in more revenue, but my costs exceed for that last unit. So the sweet spot for this would be I maximize my profit by identifying my total output being 9 units or 900 units or 9,000 units or 9 million units, whatever that case may be with the overall production. So the break-even point is where we most often want to be with our overall production itself. And this is a chart that I just reproduced from our textbook here. So you can go back and take a look at this and get a better understanding of what's going on. Here again, I've got the price at $131, so it relates to the charts that I have on the other side of this. You can see that the total revenue increases for each marginal unit that we produce by 131. But the graph on the bottom shows that increasing revenue and profit coming in, and then at some point in time, it decreases. If I were to just take a look at my total costs, and you've got to think that this is kind of a mirror image of our law of diminishing returns, is we can see our costs deviating away from our total revenue, and then at some point, again, it crosses and even has that $19 loss at the very beginning. So when we have break-even points is where our costs totally equal our revenue coming in. And at the lower level, we don't necessarily maximize our total income coming in, but the upper unit we do. And in that green area, you see that there's a economic profit all through that. The idea is, where do we maximize that profit? And the key is, or the rule that we want to take a look at, is we want to produce at that level where marginal cost equal marginal benefit. Now, just in simple terms, when we think about this, if my cost of producing one more unit is greater than the revenue coming in, and marginal benefit is our revenue coming in, the idea is don't produce that other unit. If my benefit is greater than my cost coming in, then produce that unit. Now, one of the things that a lot of people think of is our total revenue. If you look at this chart, at some point in time, the highest revenue coming in at some point in time may not be the revenue that we want to deal with. In other words, I'm getting more profit from producing 4 than I am from 3, obviously. The thing is, if I were to offer you $100 if you give me $50, your profit is $50. And you'd say, yeah, I'll be happy to do that. And then if the next day I come in and say, I will give you $100 if you give me $60. You might say, well, yesterday I made a profit of $50 and now it's only a profit of $40. The thing is you're still making a total profit of $90. And so even though the profit per unit is shrinking, you will continue to operate until it is equal to the revenue. So the marginal benefit and the marginal revenue will be equal to each other, and total profit will be maximized in dealing with that. You wouldn't say, no, yesterday it was at $50, I'm done if you're not going to give me another $50. You would take the 40, then the next day you would take the 30, then the next day you would take the 20, all the way up to $100 versus $100. So a couple of other questions that you might see. The perfectly competitive profit maximizing rate of production is what? Take a look at those answers and we'll wait a few moments. So the answer to the perfectly competitive profit maximizing rate of production occurs at the point at which marginal revenue is equal to marginal cost. Another typical question, which of the following is true for the perfectly competitive firm? Price and marginal revenue are always equal. Now, one of the things that we're going to see when we get into the other three less competitive markets is that price and marginal revenue are going to be different. Marginal revenue is going to be less than the price at all levels. But for the perfectly competitive firm, price and marginal revenue and demand are all going to be equal. So as I mentioned before, we want to minimize loss or maximize profit. If we're not maximizing profit and we are in a situation where the price drops, let's say that there's a bumper crop of corn and so there's a greater supply and the price is naturally going to drop, you may not want to give up your farming capacities, but you want to minimize whatever loss you're faced with. You want to still produce because the price is greater than your average variable cost. So think about this for a minute. When you look at the different costs, you have your fixed costs and your average variable cost. If I shut down, I still have to pay my fixed cost. If the price is greater than my fixed cost, then that revenue coming in for each unit that I sell is going to cover some of those costs. If I shut down, I've got to pay those fixed costs out of my own bank account, out of my own pocket. So if I can cover my average variable cost, the cost of my employees, for example, let's say that's the only cost that I have, and if I have $100 in fixed costs, then the price coming in covers that fixed cost and covers part of the compensation I have for my employees, I'm better off operating at a loss for a short period of time. I can't do it forever, but if I expect the market to come back, I will operate as long as I'm covering my average fixed cost, because that contributes to my out-of-pocket cost for my fixed cost. So again, why does a firm still produce at a loss? Because the revenue coming in does cover their average variable cost and contributes to the fixed cost that I have to pay.
So when like places go bankrupt, they're losing money in every facet, right? They're not gaining and you can cover the costs.
Right. So if you're looking at a bankruptcy, one of the things you're looking at is that the revenue coming in for whatever units I'm selling and what have you, obviously doesn't cover my average fixed cost and doesn't cover all my variable costs. And so for every unit that I sell, I'm compensating out of my pocket whatever I have in savings. Or if I don't have any savings, because I run that down, and that's another cause for bankruptcy. So again, just to clarify, because I know that I want to make sure that we're understanding this, is in this case right here, you can see that the price of $81 is less than the $100 that it costs to cover all of my costs. So the optimal level of output is that point where marginal revenue equals marginal cost. So look at the $100, that's my marginal revenue, and it intersects with my marginal cost right at the point where my average total cost. So those three things intersect. That's really the optimal level of output. But here the prices drop to $81. At $81, I have a loss. Okay, I'm still covering my average fixed costs, my average variable costs. Yeah, with the money that's coming in. So what that means is that $81 is covering my average variable cost at producing 6 units, obviously, by quite a bit. That would be what, about $60 for my variable cost. And so $81 is coming in. I have a $21 above my average variable cost. So I would continue to operate for a short period of time. I can't do it forever, but I would continue to operate, minimizing my losses by producing 6 units. Now, speculate for just a minute. If I said, well, I'm going to produce 8 units, then I'm increasing that difference between my cost and the price. Can you see that difference coming into this? So if I said I'm going to produce at 8 units here, then my marginal cost is going to be up here around what, $130, yet my revenue coming in is still going to be 81. So 50 units for $50 for every unit that's coming into this doesn't make any sense. So I'm not going to produce less because, again, the same thing. Okay, I'm only going to produce 3 units. Yeah, you can still see what's happening. I'm contributing more to the production in both cases than I'm gaining anything coming back. So yeah, there's a point in time where I'm going to continue to operate in a short period of time by minimizing my losses, shrinking that gap between my average total cost and the price. And my average total cost and the price, that's going to minimize my loss coming into this. So again, reconstructing our cost curves, just to clean things up a little bit. If my price dropped, however, to $71, so here I'm not covering my average variable costs. In other words, what's happening, I'm paying my fixed cost, and I'm paying the gap between the price right here and my average total cost. So again, I'm contributing not only, I know that's, but between these two lines right here, I'm contributing more to pay salaries or raw materials or what have you than the price. I'm not only covering my fixed costs, but I'm also covering a portion of my variable costs. And so it would benefit me to shut down and just pay my fixed costs rather than trying to pay fixed costs and the gap between my variable costs. So here again is my short run profit. The price is less than my minimum average. So here we have a $3 kind of a thing. So the next question is, when do I shut down? At what point does the price vary so much that I decide I need to just shut down? And here's the shutdown case. If we look at this, we're looking at the point where my marginal revenue is equal to price, obviously, and the price itself is equal to my average variable costs. When it's equal to the average variable cost, then it's really kind of one of these things where I make that decision to either continue to operate because I'm covering my fixed costs, I'm covering my variable costs, and I'm still losing money because my average total cost is there, and I'm indifferent. If I want to preserve my employees' jobs, then I'll continue to operate. But that's the same output that I have from my bank account as if I shut down. If it drops below that average variable cost, then it is shut down. So what I'm showing you here is the shutdown case. Now, the other thing I mentioned a couple of times, but I'm not sure everybody has understood it, is our marginal cost curve is the supply curve for the firm. And when we look at the industry, one of the things that we're looking at is the summation or the addition of every firm's marginal cost. So at the point where I hit that upswing of my marginal cost, that marginal cost is exactly the supply curve that I'm willing to pay. And when I ask the question, what are the incentives of a firm to produce more if the price goes up? And it's twofold. Number one, increased profits, and everybody gets that. The one that I think people have a hard time getting is the fact that it also is I'm able to cover my costs. Is you can see that as I produce more units, my costs are going to go up from that point where I hit the marginal cost curve starting to trend back up. So again, the marginal cost of a firm in a perfectly competitive market and you add up all of those little firms, each of those marginal cost curves from each of those firms is equal to the industry supply curve. Does anybody have any questions on that? Anybody online? Okay, a couple of other questions. In this figure, if the firm is facing demand curve 4, so you've got to kind of take a look at that, then to maximize profits, it will produce at what level? So we have our quantities at the bottom, labeled A, B, C, D, and E. And if we're producing at 4, so 4 would be the level, 4 would be this level right here. So it would be B. Okay, so again, it's at that point where marginal benefit equals marginal cost. So as I drew this line,
Wait, how does that be?
oh, it's not. It would be D.
Yeah.
Okay, so let's scratch that.
No worries. I was like, that doesn't look like B.
No, it's not B. It's right here. So that is wrong. Okay. So just to review, the optimal level of production is going to be where marginal cost equals marginal benefits. And that is a break-even point. Now, one of the things that I want to emphasize is as these firms produce at break-even points, they're happy, happy, happy. Now, why would you say if there's 0, if my costs are just covering my benefits, does that mean I'm not making any money? And why should I be happy, happy, happy? And one of the things we need to remember is we're looking at economic profit. So we've already put into this our opportunity costs. If we break even and we've added not only our financial, so we are making a profit financially, and if we're break even, that means there's no other investment, no other activity that we're doing that could make us better off. And so we're happy, happy, happy if we hit that break even point, because number one, that maximizes our profit coming in. It identifies the output that we're looking at. And so we're happy in doing that. Now, if we go to 0 economic profit, where our marginal costs are greater than our marginal benefits, then we have to make that decision as to whether or not we're going to shut down or not. As I mentioned before, and this is just kind of a summary, is shutting down in the short run does not mean shutting down permanently. Low prices can be temporary, and some firms switch production on and off depending on the market price.
Which firms would be those types of production?
So if we're looking at apparel companies, for example, now they're obviously each season there's different things that are going to be profitable and not. And so if selling a certain style, a brand of jeans, for example, is not profitable, I mean, you still may produce those lower price jeans, but not as many. So you'd move your quantity over. But you might switch to something else. You know, you have machinery, you can retool, or whatever the case may be. You know, if you're building skateboards versus scooters, it could be one of these things. Well, scooters aren't selling very good this year, so we're gonna go to the skateboards. You can take that labor and redistribute it to something else. You can take machinery, redistribute it. And so you may continue to produce some lower level, and you're changing that because the price has changed. But also, if you limit your supply, a couple of things are happening in the market itself. I limit my supply, and if I can have my competitors do the same thing, then the supply curve is going to shift, and it's going to raise the price back up. So that would be one of the things where you'd maybe shut down for a short period of time, expecting to come back as that changes. But also, if you are well financed and other firms are not well financed, you would have firms leaving the industry. And as they leave the industry, again, that supply curve is going to shift to the left, raising prices. And then you're back into the industry where you're making money on the things that you use. Does that make sense? Okay. All right. Anybody have any questions? I will post, obviously, this Zoom online. And I will also produce these slide sets online so you can take a look at it and pour over them a little bit more. So anybody have any questions? All right, good enough. And we are done for today.
Thank you for clarifying.
Well, sometimes this is, one of the things that I want to just identify is this lady right here, who's a PhD student at Harvard University. She has some interesting videos as part of her PhD studies and what have you. But you may want to go in and take a look at Jody Beggs and see some of the videos that she's produced, because this is another way of clarifying what's going on. So.
In the short run, firms have paid their fixed costs.
She'll go
in
on
order
to
to be
this. I'm not going to do that today, but I think this is something you can look at yourself. All right? All right. We are good to go then. And again, if you have any questions, just let me know.